Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 14th of April. I'm Daniel Lam, your host for the podcast. Over the weekend, there was the news of tariff exemptions on Friday on electronics like smartphones and laptops, which was later downplayed by U.S. Commerce Secretary Ludwig on Sunday, saying that it was temporary until the Trump administration develops a new tariff approach specific to the semiconductor industry. Well, this sums up the current market situation in a nutshell. There's still a lot of flip-flopping in U.S. trade policy, and that remains the primary driver of markets. The focus now turns to negotiations with key trade partners, with Japan, South Korea, Vietnam, and India reportedly amongst the first in the queue. However, the trade war with China has escalated, and developments there will be increasingly important. So we looked at three different scenarios. Our base case is that we're expecting an economic soft landing as Trump seals deals with key trade partners. Now, we have witnessed the volatility in the US markets when the US bond market sold off and acts as a check and balance factor that led to Trump's U-turn last week, as well as the Trump put. In this scenario, growth falls below trend, but the US avoids a recession as the Fed cuts rates by 50 basis points in the second half of this year. Meanwhile, focus moves to tax cuts and deregulation, helping risk assets to recover by year end. So under this scenario, we're expecting S&P 500 index to end the year around 6,200 and the US 10-year bond yield around 4 to 4.5%. The downside risk scenario is where a slowing growth and high inflation if negotiations fail and some tariffs come into effect. Now, the Yale Budget Lab estimates that the Liberation Day tariff, if they are to be reimposed, would be raising the average US tariff rate to 22.5%, which is the highest since 1909. The short-run impact would be a 2.3% additional rise in US consumer prices, a 0.9% cutback in GDP growth, and 0.5% rise in unemployment rate. And there is a spillover effect, so the impact of higher US tariff on inflation, consumer and business confidence, job markets, and corporate earnings could lead to a mild recession as the Fed holds off rate cuts due to near-term inflation spike. So in this bear market scenario, the S&P 500 is likely to be retesting the key level of 5,000 and the US 10-year yield going to 2.5 to 3%. And finally, the upside risk scenario, where successful tariff negotiations and monetary plus fiscal policy stimulus in China and Europe are possible catalysts for upside to risky assets. US policymakers move their focus to tax cuts and deregulation. China top policymakers boost domestic consumption and cut lending rates and bank reserve requirements. And in Europe, Germany's incoming government could decisively boost fiscal policy, lifting euro area's potential growth outlook. So here in this scenario, the S&P 500 index ends the year around 6,650, the US 10-year yield between 4.5 to 5%, and the US dollar falls as non-US growth improves. So given our base scenario of an economic soft landing, we would be looking to add to our preferred sectors with a diversified allocation on pullback. So these include US software and communication services, as well as banking. In Europe, banking and industrial, and in China, high dividend paying non-financial state-owned enterprises, and the Hang Seng technology sector. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.